All right, hello again, everybody. This is Mike with the Netpicks Inner Circle. In this week's options trade of the week, we're going to take a look at PayPal, symbol PYPL. The overall market has been on an absolute tear to the upside, specifically with many of the tech names inside of the NASDAQ of late. As a result, we have a lot of overbought markets right now. You start to take a look at Amazon and Facebook, Netflix, Tesla. They've been very impressive on the upside, but that also gets us into sectors like the online payment processing companies. You take a look at PayPal, you take a look at Square. They've been very, very strong on the upside. I think there's a lot of opportunity here to potentially play for a period of consolidation or even a pullback. If we get a pullback, that's great, but I want to position myself to where I can still make money in case we get into that choppy stretch. So what you're looking at here is a 195-minute chart of PayPal. I prefer the 195-minute time frame to the daily chart. That 195-minute chart gives you 2 candles a day instead of 1, so it speeds it up just enough to where we get more frequency, we get a more reactive system, and it's a good fit for what we're seeing. What I find, the daily chart, it just lags too much. It's slow to react, it's slow to get us into trades, and I find it's difficult long term to be successful with that. I much prefer the 195-minute chart. The indicators that you're looking at here, this is our Spotlight Power Trader system. The nice part about this system, it's got everything programmed into it. So when all of our criteria is met for a setup, you're going to see an entry point, you're going to see targets, and you're going to see a stop plot on the chart in real time. At the time of this video, look at the far right edge of the chart. You're seeing that we have a green setup there. The potential is there for a short trade going into next week. The reason we like those indicators to plot the entries for us, it takes a lot of the guesswork out of the equation. When I buy a call or a put option, I only have one way of making money on those trades. I have to get a big directional move in my favor, and it has to happen in a timely manner. If it takes too long, the time decay is going to hurt us. I'm not opposed to buying options. In fact, that's a big part of what I do because it gives us a bigger profit potential. I just realize up front I've only got one way of making money, so I'm going to have a lower probability of success with a higher potential return if it does move in our favor. So I use the indicators there to time my trades much better. So in order for me to buy a put option here on PayPal, I have to see over the next couple of days that price action gets down and hits that entry point. That entry point would be that green dot there on the chart. However, there are other opportunities that I can take advantage of by using options. I don't have to buy calls or puts exclusively. As we talked about in previous videos, there's ways that I can sell a call spread or sell a put spread. That way I can give myself a wider range of opportunity there to make money. So let's talk about selling a call spread here. The reason I'm doing this, we are in an overbought condition. I can see that on the chart, but look at our Netpicks pulse indicator down at the bottom. That's that red and yellow histogram down at the bottom. What that indicator is doing is taking a look at the standard deviation channels that we like to plot on the chart. Now, instead of putting them on the chart here up at the top, the reason I don't like to do that on every chart, it adds in too much information. That chart gets too messy, it's too difficult to make sense of everything that's going on. So the pulse indicator, what it does is it takes a look. On the chart, we like to put 1, 2, and 3 standard deviation channels. When I start to get yellow bars like we've seen here, 4 out of the past 5 bars have been yellow. That indicates to me that we are between the 1 and 2 standard deviation channels on the chart. That's another indication to me that we're nearing an extreme. Doesn't mean that price action can't move higher. It can from here. It's just going to become more difficult. Chances are, at the very least, we're going to start to get sideways and choppy in here. That's why I don't want to buy a put yet because we haven't seen an entry price hit on the chart, but I am open to selling a call spread. I'm willing to sell premium here. When you start to sell options, you have multiple ways of making money. As a result, the timing of the trade doesn't have to be perfect. So we're going to walk through a trade. So again, the reason I'm looking at selling a call spread here is we have an overbought chart condition and I'm using our pulse indicator down at the bottom. I have to have 3 out of 5 bars there on the far right edge of the chart. I need to have 3 out of the last 5 bars be yellow. So I've got that here on the pulse indicator. That tells me I can go ahead and sell a directional spread, but I'm going to do so in a little bit more cautious manner. So what that means is I'm going to take it with a smaller position size. This is not a trade I'm going to jump in with both feet on. Okay, I'm going to cautiously get in with around 50% of my normal position size. Let's go over to the trade page and let's piece this thing together. Now, PayPal, it does have weekly options. If we open up some of these weeklies, there's some liquidity in there. There's some volume and open interest, but I'm not interested in the weeklies at this point. I'm going to go out to the monthlies. How do I know whether to trade the weeklies or the monthlies? Is there a formula there that I look at? There's not. A lot of it depends on a couple things. Number one, my outlook for the overall market. How aggressive do I want to be? If I go with those shorter term weekly options, that's about as aggressive as you can get. I also want to take a look at what my overall portfolio looks like. What type of other positions do I have on? Do I have a lot of weekly options on at this point? Am I lacking on the monthly option side of things? You can take that into the equation. So I've got a lot of weekly options on right now with my short premium trades. That's the reason why I'm going to go out to July. Okay, I'm going to go out to the July monthly options. They have 28 days left. It's just going to give me more time to hang on to this trade and not feel so pressured. Just in case I'm a little early, just in case the market is not ready to move to the downside yet, I don't have to worry about that. I can hold on to the position a little bit longer. What I'm looking at here is selling an out-of-the-money call spread. So I'm going to go out to those July options with 28 days left, and I'm going to take a look at selling the 86.5, 87.5 call spread. So that means I'm selling the 86.5 call, and I'm buying the 87.5 call at the same time to make it a risk-defined trade. The current price of PayPal is at $85, just over $85 a share. So by selling the 86.5 call, I give myself a little room there on the upside to be wrong. When you sell a call spread, it's a bearish position. Ideally, you want PayPal to move to the downside. But you've also got a little bit of a neutral kicker built in there. And what I mean there, by selling the 86.5 call and by collecting 37 cents, and actually at the time that I clicked on this trade, let's go ahead and lock this price in. Let's call it 40 cents here. It's kind of bouncing all over the place. Let's say we collect 40 cents. Our break-even point is going to be at 86.90. It's taking the short call strike, the 86.5 strike, we're adding in 40 cents, and that puts my break-even point at 86.90. I just need price action to stay below that level. If it moves up, down, or sideways, I'm okay with that as long as it stays below 86.90. So I've got about $1.90 that I can be dead wrong on this thing. It can move up almost another $2 over the next 28 days, and I'm still okay. The only move that hurts me here is a big move to the upside. So if we get a larger than expected move to the upside, above that 86.90 level, that's when I start to get in trouble. The reason I like this trade is we already established that we are at an overbought extreme. There's a slim chance that this thing is going to make a big move to the upside from here without first pulling back or giving us a period of consolidation. So I really like how this is developing. I also make money from time decay adding up, and I make money if volatility decreases. So now I give myself 5 potential ways of making money on this trade. Instead of the one way of making money if I just buy a long put. So there's trade-offs here. The long put's going to give me more profit potential, but it's also going to come along with more risk. Here on this short call spread, it has a lower profit potential with a higher probability of success. Whatever I collect here, if I collect the 40 cents on this trade, that's the most I can make regardless of what happens. If we get the market just to make a large move to the downside, let's say the bottom falls out of PayPal, the most I can make is that $40 per spread. So it's a fully risk-defined trade. The most I can lose is $60. So I'm taking the difference between the strikes. There's a dollar-wide difference between the 87.5 and 86.5 strikes, and I'm subtracting the 40 cents that I'm collecting to put the trade on. That gives me my 60-cent maximum loss scenario there if the trade works against me. So it's actually a pretty decent ratio. A lot of times we are in the risk 2, risk 3 to make 1 type of scenario when I sell a spread. We're actually much better than that in this situation here. We're right around a risk 1.5 to make 1. And then also the beauty of this trade too, I mean, it's an $85 stock. With some of these expensive stocks, the options get expensive as well. By selling a call spread here, we're tying up $60 of capital per spread. You can put it on 10 times and have $600 at risk. If you've got a smaller account size, put it on 1 or 2 times. You've got less than $200 of risk. It's a pretty manageable trade regardless of your account size. So what do I want to have happen here? Ideally, any type of a move to the downside would help me. However, I can also make money from a move sideways or a slight move higher. How do I manage the trade? I'm targeting 50 to 75% of whatever I collect to put the trade on. So if I collect 40 cents here, if I can buy this thing back between 10 and 20 cents, that would be ideal. That would give me a really nice profit. I'd book the profit and move on to the next trade. Right, so just a really easy way of coming in, finding some exposure here in some of these overbought names. You know, I understand if you want to be cautious on the downside. I do too, because there's been no selling at all in this market, specifically in the tech names. It just continues to be rock solid. So, you know, if you want to cautiously, you know, position yourself for a potential, you know, slowdown, you know, going into the summer months, you know, instead of getting aggressive just buying calls and puts, this is a way where you can lean a little bit bearish with a neutral kicker there. Stay active, you know, give yourself some nice profit potential without requiring a big directional move. That's why I love these types of trades. So we will certainly take a closer peek at this one here over the next couple of weeks. We'll see how it plays out. With 28 days left, we have time here. We can be patient. You know, the P&L is not going to become all that active right off the bat. This is a trade that, you know, it's one of those, I don't want to say set it and forget it, but it's about as close to that as you can get. You know, we're going to put it on, we're going to let it work for us, you know, and see what happens over the next couple of weeks. All right, we had one open position here from a couple of weeks ago, and it was on Target, symbol TGT. Let's go ahead and take a look there. And on Target, we actually sold a call spread in the weekly options, which are expiring here today. And we sold the 79.80 call spread. So this one we talked about a couple weeks ago. This is essentially an attempt to recover from a loss that we took on an Iron Condor. We sold an Iron Condor back a number of weeks ago that ended up losing for us, and we took about a 49-cent loss on the trade. So it was one of our few losing trades that we've taken with the options trades of the week here. But our opinion hadn't changed. We still thought there was opportunity there on Target. So what we did a couple weeks ago is we came in and we said, okay, we took the loss on the Iron Condor. There's no way around it. It was just a losing trade that did not work. However, to try to battle back, we came in and we sold this 79.80 call spread, and at the time we collected 36 cents. $36 per spread, and it tied up $64 of capital to put the trade on. So it was another very manageable trade, and we were trying to battle back and try to limit the damage that we've taken on Target. Well, lo and behold, this trade has worked for us. Target has moved to the downside. We needed it to stay below 79.50. It's done so. It's about $3 below that level. That call spread that we sold is going to expire worthless today. We're going to keep our entire $36 profit from that short call spread. So now we've taken two trades on Target here over the past month to 6 weeks. We took a 49-cent loss on the Iron Condor. It was essentially a full loss. It was the worst case scenario. But we battled back. We collected the entire 36 cents for this call spread. So now I'm only down 13 cents. I'm down $13 per spread. This is a perfect example of why, you know, just because you have a losing trade like we did on the Iron Condor on Target, doesn't mean you just ignore it and walk away from it and say, oh, I took a loss, I don't want to trade that one anymore. We looked at it as an opportunity, you know, to stay active on Target and try to battle back. So now I'm only down 13 cents. That's a very small loss. So just a perfect example. Don't get intimidated by the losers. They're going to come. It's part of trading. As long as you're properly positioning yourself with good size, good small size, you can make money long term. You're going to have winners, losers, and break evens. As long as you're winning more than you're losing, which we certainly have. You know, go back and review the trades of the week here over the past number of months. We have a very high winning percentage. Okay, long term, you know, we want to make sure that you know, we're able to battle back from those losers very quickly, and the numbers are backing that up. So really nice trade there on Target. We are now left with this one open position, the new trade that we talked about here today on PayPal. So if you have any questions at all here on any of our open any of our open positions going forward, or any of the closed positions that you've reviewed in previous videos, let us know, and we will be in touch right away. You can either leave a comment here in the blog or send me an email directly to mike@netpicks.com. Right, so I'll wrap this video up here. I'll be back next week. We'll take a look at the PayPal position and then also talk about a new trade at that point. Enjoy your weekend, everybody. We'll talk to you next week.